Welcome to this explainer on fundamental valuation. Today, we're stepping right into the shoes of a professional sell-side equity analyst. Our mission? To rigorously evaluate a truly fascinating aerospace company, RKLB, ticker symbol RKLB. We're going to rely strictly on the raw financial data from their filings to see if we can pin down a true intrinsic value for this stock. But as you're about to see, taking textbook financial models and applying them to a hypergrowth space company creates quite the mystery. Just to put things into perspective right out of the gate, consider this. $45.3 billion. That is RKLB's current market capitalization. It's an absolutely massive number. But it begs the question, how exactly do we systematically value a company operating in such a capital-intensive, futuristic industry using only the historical data we have on hand? When a company is quite literally shooting for the moon, do traditional valuation metrics keep us grounded, or do they just completely fall apart? Here's our analytical roadmap for today. We'll start with massive growth versus missing profits, move on to when traditional models break, look at their sky-high relative valuation, check in on financial health and liquidity, and then wrap it all up with the analyst's final verdict. All right, kicking things off with Section 1, massive growth, missing profits. The contrast here is, well, that's pretty wild. On one hand, we have a 5-year compound annual growth rate for revenue sitting at a blistering 67.38%. Their top-line expansion is incredibly strong. But then reality hits at the bottom line. The trailing 12 months net income is negative $198.2 million. So as an analyst, our core valuation challenge is set right here. How do you value a machine that's growing at over 60% a year but is burning through nearly $200 million to do it? And despite that lack of profitability, just look at how the market has rewarded them. A jaw-dropping 360.58% return in 2024 alone, followed by another 173% in 2025. And year-to-date in 2026, it's already up over 12%. The market is clearly pricing in a massive, highly profitable future. But hey, as analysts, we can't just look at stock momentum, right? We have to actually run the models. Moving on to Section 2, when traditional models break. So we usually start with one of the oldest tools in the analyst toolkit, the dividend discount model, or DDM. This method predicts the price of a stock based on the sum of all its future dividend payments, discounted back to their present value. It's a fantastic, reliable model if a company actually pays dividends. But we immediately hit a brick wall. RKLB has a historical dividend growth rate of exactly 0%. They don't pay a dividend, and honestly, given their growth stage, they aren't going to anytime soon. So we have to explicitly state this limitation and immediately discard the DDM. It's completely inapplicable to RKLB. Okay, scratch the DDM. Let's pivot to a more versatile absolute valuation model, the discounted cash flow, or DCF. Typically, here's what we do. We derive unlevered free cash flows, estimate the weighted average cost of capital to use as our discount rate, build out an explicit 5 to 10-year forecast, and finally calculate a terminal value. This is the gold standard for finding the intrinsic value of an asset. But here's the kicker. We actually need cash flows to discount. Look at the data from the filings. The trailing free cash flow is currently negative $321.8 million. The FCF yield is negative. The 5-year growth rate for free cash flow is totally flat at 0% because, well, it's consistently negative. Any DCF model built on this baseline would require us to invent incredibly aggressive external assumptions about when they'll suddenly turn profitable, not to mention throwing in a sensible default 2 to 3% terminal growth rate. Relying on a model where the entire value rests on assumptions made a decade in the future, that severely skews the reliability of our intrinsic value calculation. So what about the other heavy hitters? Well, as a strict analyst, sticking only to the data we have, the residual income model is out. It requires positive forecasted net income, which we don't have. The adjusted present value, or APV, needs detailed debt tax shield data to separate the base firm value from financing side effects. And the sum of the parts model demands rigorous segment-specific financial reporting. So I have to state clearly, without segment data, tax shield projections, or positive net income in our source documents, we absolutely must skip the APV, SOTP, and residual income models entirely. The absolute models are quite literally breaking down. Which brings us to Section 3, sky-high relative valuation. Since absolute models are a bust without massive assumptions, we have to pivot to relative valuation using market multiples. And wow, the enterprise value to sales ratio highlights the shift perfectly. Over a 3-year average, it sat at 41.06, which is already a very high number. But the trailing 12-month average expanded to over 55, and the current multiple is a staggering 73.89. Investors are paying nearly $74 in enterprise value for every single dollar of sales Rocket Lab currently generates. And this really hits the nail on the head regarding the premium placed on this stock. The price-to-sales ratio is at 75.30. Price to book is almost 25, and the enterprise value to assets ratio is sitting at 19.13. For context, value investors usually look for a price-to-book ratio under 1 or 2. Here, we're looking at multiples that are vastly higher than any traditional market averages. Normally, to compute an implied intrinsic value using relative valuation, we'd grab the median multiple of a peer group, but finding publicly traded comparables to justify a 75x sales multiple, yeah, good luck with that. Most standard aerospace and defense companies trade at single-digit sales multiples. To build a relative model here, an analyst would have to manually cherry-pick only the most extreme hypergrowth tech or space peers. And again, that forces us to rely heavily on external assumptions rather than the raw baseline data. All right, let's look at Section 4, Financial Health and Liquidity. Now, it's not all doom and gloom on the balance sheet. In fact, there are some serious bright spots in the data. Rocket Lab actually boasts a positive gross profit margin of nearly 30%. This tells us the core unit economics of their products actually work, even before overhead and R&D are factored in. Furthermore, the company operates with a debt-to-equity ratio of just 0.10. They are operating with an incredibly conservative debt load, which is exactly what you want to see here. And despite that massive free cash flow burn we talked about earlier, their liquidity is honestly rock solid. A quick ratio of 3.61 and a current ratio of 4.08 means Rocket Lab has more than 4 times the current assets required to comfortably cover its short-term liabilities. So they aren't going bankrupt tomorrow. They actually have the cash runway needed to keep executing on their vision. Finally, let's wrap this up with Section 5, the analyst's final verdict. So bringing all these data points together, what's our final takeaway? Well, rigorous intrinsic value calculations are pretty much impossible here without making wild external assumptions. Absolute models like DCF and DDM fail entirely without positive cash flows or dividends. Asset-based models like net asset value or liquidation value would require massive subjective fair market adjustments to their balance sheet and highly specialized physical assets. However, the company's pristine liquidity and low debt provide a really strong runway. Ultimately, Rocket Lab's valuation rests entirely on a narrative. Their ability to sustain that astronomical 67% revenue growth for years into the future until the bottom line finally catches up. So I want to leave you with this final provocative thought to chew on based on the data we've explored today. Does a consistent 67% revenue growth rate truly justify a 75 times sales multiple in today's market? It's a classic battle between the reality of hypergrowth narratives and the strict limitations of fundamental valuation models. Weigh the evidence, look at the runway, and decide for yourself. Thanks so much for joining me on this explainer. And as always, keep questioning the data.